You Shepard, that's exactly why you pay so much.
It's because you've got all these requests that we have to.
Good morning and welcome to the June 2023 update to the Spears & Associates drilling forecast. I'm John Spears.
And I'm Richard Spears.
Joined today with Richard. And we'll be spending the next hour going over some of the key assumptions and output from this quarter's update to our forecast of upstream activity here in the U.S. and around the world.
If you are a client of our firm, you've already gotten a big fat book. You've gotten all the data, and this is an overview that we offer to well, if you're watching it on YouTube, then you know that it's available, and it is being recorded, and it will be on YouTube on our channel forever. Yeah. So if you screw up,
you can compare.
That's right. It's not what you said last time.
Sure. So I think, Rich, you've got some rules of the road for today.
Yeah. So the rules of the road are nobody can ask John a question real time, but there's a chat box on YouTube that if you wish, you can type in your question in this chat box. I'll be monitoring it. Charlie will be monitoring it. People, the team will be monitoring it. So if you have a question, I'm going to write those down. We're going to consolidate ones that are interesting. People might email them in or text me. I don't care. We'll get them all. And at the end, I'll walk back in here because I'm going to disappear while you're talking.
You're a BB.
And then I'll go through those questions with you.
Yeah.
But it's an interesting time, and this is why I'm super pay attention to this particular forecast. Because if you look at, our clients are the big oil companies on a global basis, and all of the oil field service companies, and if you're for the 12 investors out there, those guys as well. But if you look at like Schlumberger, Halliburton, NOV stock,
The publicly
valuations.
traded oil service companies. Okay.
Since the start of the year, they've fallen by 10, 20, 30%.
Okay.
And the more domestic you are, the more your shares have fallen. But we're here in the middle of the second quarter where my bet is that these service companies are the healthiest they've ever been, maybe ever.
Financially.
And they're probably going to report a quarter that is the best quarter they've ever had in terms of earnings.
Boy, somebody's going to be surprised.
Well, it is, but it just shows you that the sector, from an attractiveness to the investor community, just continues to fall out of favor. And maybe they're anticipating this slowdown in domestic drilling that you've got.
We've been talking about. Yeah.
But what people who watch this are going to see here in a few minutes is that the slowdown isn't all that much.
No, I mean, after 2 strong years of growth, it's a bit of a bracing news. But I think the key thing that you pointed out about the oil service stocks is that they've been trending lower at the same time that the oil companies themselves have generally held up pretty well in the stock market, right?
Oh,
So,
you bet.
yeah,
You take BP, for example,
Yep.
it's flat to up slightly. Take Chevron, same sort of situation. Yeah, they've done fine. It's just the service structure around them
Right.
has fallen a bit out of favor. One of the things
we feel
also-
your pain. Is that I think the
That's-
message? Okay.
Our value is far less now. One of the other things I wanted to highlight is
Yeah.
you have an oil price forecast and you have a natural gas price forecast.
Mm-hmm.
And in the olden days of the last 40 years of doing this, it was not just the first thing you looked at, it was a big thing that you looked at the
Sweat and bullets.
forecast.
Yeah, right.
But my joke with our clients is that you come up with a forecast, you write it down, you put it in the drawer, and you close the drawer and never look at it again. How would you describe
Yeah, that's
that?
I think it's really only if you look at the correlations, as I do, in drilling activity, completion activity, and commodity prices. What you see is that over the past 3-4 years, the correlation's gone to almost zero. So whereas before it was a nice tight 90%, 80%, pretty high number. And so pay attention to where oil and gas prices are going. That'll tell you a lot about where rig activity is. Not the case anymore, because there's just not that price movement that we see for domestically as a whole. I think there's a subset of companies, small operators perhaps, who, when commodity prices go up, their bank accounts get high enough, then they go right to work with rigs, and then when prices fall, they pull back. So there's a group there that is still pretty sensitive, but that doesn't move the needle as nearly as much as what it used to. So it's an interesting point that to be made. So we'll talk about what I think then were the key elements now in constructing a forecast or understanding where activity is going to go. So we'll get into that. What do you say?
I was with some attorneys a couple days ago as they were trying to prepare a case to present to a jury, and their idea was to say, hey, let's have you guys plot oil price, and against that oil price, plot the behavior of this particular company and its competitors. And I said, you're going to be really disappointed about this lack of correlation, because it's not oil price, it's not gas price.
Not so much.
Especially if your time period is the last 4 or 5 years. All right, so anyway, if you have questions as you go ahead and type them into the chat box. By the way, if you're watching this in the future, you can type the questions in the chat box, but we can't answer it. Anyway, so it's real time. I'm going to leave you, John, to your
Thank you, sir. Okay. Very much to this June update to the forecast, and we'll get right into it. As Richard said, we spend a lot of time looking at the fundamentals for a good reason. We don't want to be surprised by actions in the market that do affect oil and gas prices. And the place we've always started, and I think it's important to start, is what's happening on the demand side globally. So got a chart here that looks at what the current outlook for oil demand is globally and what it was 3 months ago when we met last. So the blue line is our most current number, and the darker line is from February. And as you can see, it surprised me when I put this together, because there's been a lot of angst in the market about where oil demand is going, worries about China as it reopens, Initially, when those moves were being made back in the spring, the hope was that China would open up its economy, a lot of economic growth there, and associated oil consumption would grow strongly as well. And in fact, now you have much more worries about that happening. So, but still, on a consensus basis, what we see is the expectation that on a globally, oil consumption is more optimistic numbers today than what there have been in the recent past. I think what you see on the chart there is that over the past quarter, the oil consumption numbers on a global basis have been increased by about 500,000 barrels a day, now calling for something on the order of 1.6% growth this year and another 1.7% or so growth next year. So, for now, anyway, this looks to be what would represent the consensus opinion. Still a lot of worries about China and worries about the U.S. Clearly, with the Fed tightening interest rates, raising interest rates, anticipating slower economic growth has kind of been the parlor game for Wall Street. But that hasn't happened yet. The jobs numbers have been pretty strong, and so for now anyway, the outlook appears that we'll see increased economic activity and associated climb in oil consumption. This chart looks at then how the demand numbers match up with the supply numbers, right? And whether or not that means the oil market is going to be tight or loose. So red is our supply line, blue is our demand line. And as you can see in the early days back in 2021, demand was rising much faster than supply. It continually exceeded it, and so the market was undersupplied, and that's why we saw a price recovery. The market got oversupplied in the latter half of last year, the early days of this year. Supply was running higher than demand, and of course, we all remember that back in March, OPEC Plus agreed to take 1.1 million barrels a day off the market in the second half of this year because they were worried about the rate at which economic growth would happen. And they meet again starting on this Sunday, 2 days from now, to decide what their production policy should be for the second half of this year. So again, the question is, will they leave their current production plans in place? Will they take more barrels off the market in order to keep the market pretty tight, that the red and the blue lines essentially overlay each other? Because again, the key for OPEC Plus is what they're really monitoring are global oil inventories. And they want to see those inventories in a normal range, because if they can hit that kind of number, then a price of around 75 for WTI, or about $80 for Brent, seems to be what you would expect in a normal inventory situation. So I think that's what they're going to continue to monitor pretty closely. And our expectation is that they'll continue to adjust their production so as to support prices at or very close to the current level. So those are what we think is going to go on there. Now, OPEC has more control over prices than it used to, because U.S. oil production isn't growing nearly as strongly as it was back in the late teens, when we saw 2 million barrels a day or more of incremental production coming out of the U.S. at a time when global oil demand was only growing 1 to 1.5 million barrels a day. It was pretty apparent that OPEC didn't have a lot of control over prices because it was having to actually cut production in order to try and balance the market. And it didn't want to cut production back then. So, but these days, with U.S. output pretty stagnant over the past 6 months, and what we think will be the case is a decline in output going forward, that really puts OPEC kind of back in control of the supply-demand situation in the marketplace, because as it raises or lowers, it really controls those incremental barrels that might flow into the marketplace. So our numbers, based on this drilling forecasts that we have put together, tell us that we are at or very close to a peak in U.S. crude output. We see the numbers peaking somewhere around 12.5 million barrels a day. And given what we anticipate happening in terms of rig activity and completion work, We think that those U.S. production is actually going to fall over the next 18 months. So by the end of 2024, we'll be somewhere around 12 or 12.1 million barrels a day of output. We're assuming throughout this next 6 quarters that the initial productivity of new wells holds constant. So we're not forecasting a decline in well productivity. The decline in production comes about entirely because of a decline in drilling activity. So that's key to us. Clearly, were well productivity to come in below the numbers that we're anticipating, then there'd be a sharper drop in U.S. crude output. And conversely, if well productivity came in above what we're estimating, the numbers would tend to be fairly flat. But it's hard to imagine that well productivity is going to grow from where we have been. It's like I said, it's overall production has been pretty flat. The inference we draw from that is that well productivity growth has stopped increasing. And what we hear from operators is, of course, that they're each day growing closer to exhausting their tier 1 prospects and are now having to get into their second and third tier prospects, which just by definition carry lower productivities than the stuff that they've been going after in recent years. So I think the day will come when well productivity also begins to decline, and that will set up an interesting dynamic in the U.S. oil patch when that happens. But over the balance of this year and over next year, I think it's safe to say that well productivity probably won't change a lot, but it won't go up, and it might go down. But anyway, U.S. output falling, and as a result, that helps keep the market tight. Our forecast for oil prices is what you see on the chart here. We average $75 a barrel here in 2023. That's down fully 20% from what it was on average last year. We have a slight increase in oil prices expected for next year. I think we average $77.50 in 2024, so not really very much change on the oil price side. If again, assuming our demand forecast is correct, and if OPEC doesn't get into a situation where it doesn't control production in incremental barrels into the marketplace. I say that only because at the moment anyway, there's a bit of a dispute within OPEC and its other key member country, Russia, because Russia had pledged to take 500,000 barrels a day off the market, lower its own production by 500,000 barrels a day this year, and there's been no sign of that yet. Russia continues to set records in terms of its exports, so its export numbers have stayed pretty steady ever since the invasion of Ukraine. Even though the flows have gone to different countries, the flows have been redirected, but the absolute volumes have been about the same. So it's not clear that Russian production has fallen very much, and if at all, and that discussion is made only more difficult by the decision that Russia no longer will publish its production statistics. So we're working with even less information than we might have had before. So this sets up a problem inside of OPEC if you're trying to agree to how many barrels you're going to bring into the marketplace and so forth. They've got a wrestling. They've got to wrestle over and have some tough discussions about all that. I suppose there's a possibility that back in the late days or early days, I should say, of 2020, just prior to the pandemic, if you recall, a similar kind of dispute led to Saudi Arabia and its allies deciding to chase market share and punish Russia for bringing too much oil in the marketplace. And so those countries increased their production on the eve of the pandemic, which contributed mightily to the oversupply and the fall in oil prices that we saw back in 2020. So there is precedent for a dispute to end up in some kind of a market share war, but I don't expect that to be the case. But that would be maybe a wild card that we should all be alert to And presumably we would get an answer on that particular point in the early days of next week. So we also look at the gas side, and that's of course been where all the action has taken place in North America this year. We had a warm winter. Industrial and residential consumption of natural gas is lower than last year, same as in the power sector. So the consumption numbers have been pretty soft. You'll see those in a moment. The key then is that inventories didn't fall as much as expected during the winter months and now have begun to rise. There's something like 500 billion cubic feet ahead of the same week of last year, as you can see on the chart. So we got our gold line is well above the black line from last year. And the projections would suggest to us that by the middle of November, about when the inventory numbers peak, we'll be standing at or above 4,000 billion cubic feet, so 4 trillion cubic feet at that point, which it would be the highest number since 2016. So and could potentially set an all-time record, depending upon how things go over the balance of the year. So it's a soft market for natural gas, and that's why we've seen the problems on the pricing side this year. Back in 2016, as I note on the chart, when we got to 4,000 BCF, when we had another soft year in the gas market, gas prices averaged right at $2.50 a million BTU, and that's kind of the number we're looking at this year. So we are it's a classic inventory problem affecting pricing on the gas side. Just as we had said earlier, OPEC wants to focus on inventories as it sets production policies to affect oil prices. It's an inventory thing for gas as well. The demand numbers, like I said, have been fairly soft. You can see the extreme range quarter to quarter that we have here in the US, but we're tracking to be somewhere down 1% or maybe a bit more this year, and then down another 1.7% next year overall. So the price assumption numbers you see there are from the EIA. They're assuming a natural gas in price of $3 per million BTU for gas this year. So if they were to go back through their numbers and assume something closer to our figures of $2.50 for natural gas, they might expect then to see more gas use in the industrial sector, maybe more in the power sector as well. So there's a possibility that by the end of the year, that gas consumption within the U.S. might not be down. It may be fairly flat year over year, and that would go a long ways, or certainly make progress toward tightening up the market come 2024, I should say. But we're not getting much help from domestic gas demand this year on with regard to where gas prices are, until weather begins to cooperate and drives Q1 2024 much higher. I think we're going to have a long haul to get gas prices back above a $3 handle. So the thing, of course, that everybody has been pointing toward and counting on is the export side of the story here in the U.S. So again, domestic gas consumption is somewhere in the 89 BCF a day range. Gas exports, either by pipeline or by LNG, are somewhere around 20 BCF a day. So yeah, exports are now 20% of the story when it comes to the U.S. gas market, and exports have been growing pretty strongly, high single digits in aggregate. The LNG numbers alone have been rising at double-digit rates for quite a while. They're forecast to increase about 14% this year, and then about 5% in 2024. And the lower growth in 2024 comes about only because we're sort of at capacity in terms of the LNG export capability from U.S. terminals. So we end up with bumping up against the capacity numbers next year. At least that's the current expectation. One of the things that we all need to be aware of is that not only have we had a warm winter here with demand destruction occurring as a result, But the same has happened in Europe. And of course, Europe was key to the gas market last year, and the LNG market in particular last year, because of the desire among the European Union to substitute LNG imports for pipeline gas from Russia, right? That really drove a frenzy in the LNG market. A lot of spot cargoes saw very high prices. A lot of long-term deals for LNG import were signed by European utilities. And then they, as they raced to fill up their inventories, and then a very warm winter happened. And the combination of a warm winter in Europe and the high price, the conservation among industry due to these high natural gas prices has left demand much lower there. And in fact, they have the same situation going on in Europe. Inventories in Europe are 67% full. They now project at the current rate of import that they might be completely full come September. And so there's a worry that we might actually begin to see LNG cargoes canceled. Some of those headed to Europe might be canceled just because there's no room to absorb those volumes. And if that's the case, then the forecast that you see on the chart here with regard to LNG exports from the U.S. Obviously gets rewritten, and that would only contribute to further softness in the U.S. gas market. So I guess what I just want to say then is that we can't count on rising export volumes, LNG export volumes, as being a savior to help tighten the U.S. gas market as much as we would hope that it would, because there is this worry about volumes directed toward Europe and whether they will be as high as have been planned up until recent months. So gas production from the U.S. Won't be much of a problem. Again, much like the pattern we saw on the oil side, we see gas production in the U.S. kind of peaking and then beginning to decline. It rolls over at a slightly different rate because we have associated gas, which from gas produced in association with oil volumes, those will decline. We have had fairly strong numbers from the dry gas areas like Haynesville and Marcellus. But over time, then, we see a decline beginning to occur. And so by the end of next year, we think gas output will be pretty flat, Q4 2023 from Q4 2024, and Q4 2023 will be about the same number. The EIA for itself is forecasting about a 0.5% growth over that same time span. So a bit of dichotomy with regard to expectations for U.S. gas production, but in any case, I think we don't expect to see the kind of rapid growth rates that we saw, as you can see on the chart, from 2021 and 2020, early days of 2022. I don't think that's the case anymore. So again, this is all keyed to the drilling and completion numbers that we'll get to in just a second. So not surprisingly then, we see spot gas prices as staying pretty soft. Now, they're on track to end up averaging around $2.50, 2.56 per million BTU this year. That's down a full 60% from what they averaged last year. Some bit of a recovery as time goes on. We're assuming, of course, normal like winter weather, so that's why it helps sort of rally gas prices in Q1 of next year. And then that being the case, the average for the whole year goes up to around $2.90. So a bit of an improvement, but still an annual price that's below $3 per million BTUs on an annual basis. So, not a lot of change, not a lot of gas price recovery, and certainly nothing approaching the numbers that were enjoyed last year. Now, so what that means, I think it's key then to understand, well, how does that affect operators? Because clearly commodity prices are key to how much cash they can then deploy into drilling activity and the like. So we've continued to track publicly traded companies here in the US, and that group of firms, which is set to shrink when Chevron buys PDC, so we'll lose their numbers. But as a group, what you see there on this chart are their quarterly cash flow from operations by this group of companies. They peaked in the middle of last year and have begun to come down based on the oil prices and gas prices we talked about. $75 oil, $2.50 gas. We estimate that their cash flow from operations numbers for the second, third, and fourth quarters of this year will end up being somewhere around $26 to $27 billion for this group of companies. The Q1 numbers have been reported, and they were down to just below $30 billion, and we think they'll decline further over the balance of the year. So there's less dry powder, as it were, in the hands of operators than what was the case last year. In all, we think that cash flow from operations for the industry as a whole is probably going to fall about 25% from last year to 2023. So this is the reinvestment rate. So if I take my CapEx dollars and divide it by that cash flow figure from the previous chart, I get this reinvestment ratio. And as you can see, it has been increasing in recent quarters as operators have gotten busier and had to spend more for the work that they've done. And so absolute numbers from this group of 30 or so companies, I think their CapEx numbers in Q1 were around $16 billion, for example, and that represented just almost 60% of their cash flow from operations. But I think that we'll see that, and again, it fits with a forecast that says rig activity is going to soften as over the balance of the year, and as will completion work, frac jobs, and so forth. And so that leads us to believe that absolute dollars being spent will begin to decline, and that this reinvestment ratio, like we see on the chart here, will also stabilize at somewhere around this 60% figure, which will be high relative to the 2021 to 2023 timeframe. But we all have to remember that back in 2018 and that reinvestment was 120% of cash flow. So this reflects, in my mind, the capital discipline that we all hear about, and is really strong with the management teams in these oil operators, I should say. So if you've got $26 or $27 billion worth of cash flow from operations, like we saw in the previous chart, and if spending among this group of companies is around CapEx spending is around $16 billion, that leaves you somewhere around $10 or maybe $12 billion as to use for other purposes. And so this chart is one where we look at what actually then has been the how have oil companies spent, how much money have they directed toward retiring debt and buying stock back. So again, this is over the 2021 to Q1 of 2023 timeframe. Blue is debt reduction, red is stock buybacks, and as you can see, I've stacked them up against each other so you can sort of see the individual performance. Debt retirement was a huge factor in rising all of last year, but has declined in recent quarters as stock buybacks have risen. Last quarter, the industry spent about, if I remember correctly, somewhere on the order of around $12 billion for in Q4. It spent around $12 billion for the combination of debt retirement and stock buybacks. In Q1 of this year, the number was around $8 billion, if I remember correctly. So about 25 to 30% of cash flow from operations is currently being used to retire debt and for stock buybacks, and I think that kind of number, that $6 billion figure, is probably what we can expect to continue to see going forward, because I think management teams are going to try and protect their buyback and their debt reduction programs and adjust CapEx so as to, in a way that that means that they're able to achieve these deleveraging and shareholder return targets. Again, many of the management teams, their bonuses are tied to various measures of financial performance, and so not surprisingly, that's what they want to protect going forward. So I think that's first call on cash flow from operations, and then the CapEx figure has to adjust to itself then to reflect what's left over after those dollars get handed out. And so that's one of the reasons then why we see in an environment where commodity prices stay fairly soft over the balance of the year, and cash flow from operations then is itself fairly flat, and first call for those dollars going toward these financial targets, then you end up with kind of an absolute cap on how much the industry can spend on new wells and completing and completions. So that leads us then to our forecast of drilling activity. So we have long called for, and of course many operators made it plain that they were going to reduce activity because gas prices were so soft starting in January. But it's not surprising to me that we've only begun to see that the rig count reflect that those kind of changes in drilling plans. During the first 4 months of the year, I think rig count fell 2%. It was down 14 or 15 rigs, something on the order of that, a quarter-to-quarter basis. And I think the rigs that we saw coming out of the count at that point really came from small operators who had jumped in with both feet last year when they were $99 prices for oil and $8, $9 gas prices. And so the bank accounts could support getting a rig to work and spending $10 million per well to get it online and drilled and online, and maybe they could employ a rig for 2 or 3 months. So there were a number of companies that did that. It accounted for a certain portion of the rig fleet, but as prices fell, bank accounts weren't as full, and so those rigs got laid down. And so I think a lot of churn in that sector of the market, but I think that's the rigs that we saw coming out of the count the first 4 months of the year sort of were among that group of the operator community. Since the 1st of May, then we've begun to see rig count come down much faster, and I think that's a function of these larger operators who are taking big whacks at their program in response to lower gas prices. And we think that'll probably run through the end of June, and so that they adjust their drilling programs by that time, by the end of the month, by the end of June, in order to reflect what they can sustain then going forward. So our rig count number has come down and then basically run flat for the balance this year, roughly at their July 1st level. And then they stay fairly flat in 2024, because I think if you've reset your spending and your activity numbers in light of current prices, $75 oil, $2.50 gas, and those numbers don't change very much in 2024, we don't think that there's much of a change in drilling and completion activity in 2024. So our numbers come down through the middle of this year and then hold flat over the next basically 5 to 6 quarters. And so what we end up with when you measure it on a year-over-year basis is a rig count of 710 active rigs, which is down 1% from last year. But if you just measure it from a Q4 of 2023 to a Q4 of 2022 to a Q4 of 2023, the numbers are down about 13%. So our aggregate annual numbers for drilling and completion haven't changed all that much, but certainly we've become more bearish as to the outlook for the second half of the year, and now we have rig count averaging somewhere around 675 rigs or thereabouts in the second half of 2023 here in the U.S. So. And again, this chart just talks about where the hit's going to be taken. So the gassy areas, Haynesville, in particular is going to be down pretty sharply. Marcellus is down a little bit, we think, and then everything else is going to take its own hit, because the other category tends to be in higher cost areas, the mid-continent and so forth, out in the Rockies. So higher costs on a per MCF basis, and aren't as many rigs working out there, and they too will suffer the consequence of this decline in economics, as it were. We send out, as Richard said, detailed spreadsheets with the numbers supporting the forecasts, and one of the tabs looks at the U.S. market by region by well pass. So we have a dozen or more regions in the U.S. for horizontal drilling, and then directional, and then vertical, and the number of rigs, wells, spending footage, and spending associated with each one of those. And if you care to, look at those kind of details, what you see is that oilier basins really are pretty steady year over year. So, for example, the Permian is, I think, actually up a little bit in 2023 from where it was in 2022 on an annualized basis. So, again, most of the hit that we see happening on the rig count side is in the gas plays here in the U.S. and not so. It's certainly not in aggregate, because again, what we're hearing from operators is, well, the $75 price is close to what we had been planning around, and so the economics supporting our oil work are fairly much intact. It's on the gas side where the story has gotten a lot darker. Frac activity is another interesting one. Again, we see frac count down about 3% this year, measured in terms of frac jobs, and down 5 or 6% next year in terms of frac activity. So again, same kind of a pattern, coming down and then holding steady in the second half of the year, but no growth in 2024 from the second half of 2023 levels. For those of you who follow the count of drilled but uncompleted wells, the DUCs, there's been a lot of change there, because I think in April, a lot of wells were reported to the Frac Focus database, and it mightily impacted how the Energy Information Agency goes about calculating well completions and drilling activity basin by basin. So they have a drilling productivity report, DPR, that comes out each month. That's where you find their count of DUCs, and so a lot of old wells got turned in, and that's caused them to adjust their counting process and the like. We look at the same data, but we don't tie the frac activity numbers to rig count. That's something that the EIA does, and I've always found that a little bit goofy. I think that's the technical term we use around here. And so instead, we try and track the activity well by well themselves. And so so our numbers haven't changed a lot, but we do certainly want to reflect in our estimate of frac activity the fact that if we're drilling fewer wells, that the frac job count is going to fall accordingly. I guess the inference is that the inventory of drilled but uncompleted wells will hold relatively steady over this kind of time frame. I think right now the numbers suggest that there's a little over 4,000 drilled but uncompleted wells in the inventory here in the U.S., which is, I think, a fairly stable number to plan around going forward. Well, I do want to spend some time talking about the rest of the world. Canada, again, we've not changed our aggregate numbers all that much. We had been anticipating that activity would soften relative to last year. So if you do quarter-to-quarter comparisons in 2023 versus the similar quarters in 2022, we had expected that, particularly in the second half of this year, that activity would be much softer. So the Canadian numbers, really reflect what's happening in oil prices about 6 months prior. And so we had a very strong Q1 number in Canada this year, but that was because oil prices, of course, were very strong in 2022. As prices have softened this year, we think that rolls through to activity in the second half and then in 2024. So we're looking at a moderate decline in aggregate, but again, by the time we get to the third and the fourth quarters of 2023, they're going to be down in the order of 10 to 15% relative to the third and fourth quarters of last year. So similar type of pattern affecting Canadian activity for the very same reasons. Disappointing realizations with regard to oil and gas. So, for example, right now the spot Western Canadian WCS price is around $63.50. I think the initial estimates for activity last year were based on an assumed price of around $83.50, and the spot AECO gas price is $1.50, and it was basically 3 times higher than that in their price estimate. So again, operators in Canada are having to adjust their activity levels because both oil and gas prices are lower than what they had been anticipating they would be, and this is beginning to impact activity in over the balance of this year. International is a market that looks pretty good by comparison. So up about 14% in aggregate, led by the Middle East and Europe. This chart just looks at the year-over-year change on a regional basis. And so you can see that in 2023, we are finally getting to the point where all areas are enjoying some growth. It's at different rates of growth. One of the reasons Europe is up so sharply this year is because Ukraine is part of our European rig count, and of course Ukraine activity was hit by for the first 6 months of last year was hit by the invasion. Since then, rig count has come back in that country, and as it has once again shown up in the numbers, that gives us a sharp percentage increase in Europe. But believe me, it's all because of Ukraine. It's not because of activity in the North Sea. We'll talk about that in just a second. So active rig count internationally then ends up being somewhere around 925 active rigs, 9,600, 9,700 wells drilled, and a little over almost 72 million feet of holes. So like I said, in aggregate up about 15%, although there are regional differences happening this year. Middle East will account for about 40% of that incremental growth that we see in the aggregate international numbers. So, so again, it becomes a shining star, both in terms of the absolute numbers of rigs as well as their growth year over year. A number of countries there, Saudi, Abu Dhabi, and a couple of others are underway to increase their production capacity and are spending money accordingly. Offshore rig count is also up. We see it up about 14% this year, and you can see the numbers down there at the bottom of the page. 200 active rigs, thereabouts 2,200 wells or so, 20 million feet of hole. The issue there on the offshore rig side is how many rigs can, from this point forward, can be put to work, because we're approaching near full utilization, both for drill ships, floaters of all kinds, I should say, and jackup fleets. So, so that's why we've kind of capped the offshore numbers going forward, is just because there's a lot of interest in deep water exploration and offshore development, but the rig count's limited from what can go on at this point forward, which is why the firms that serve that market, Transocean and the like, expect to see the day rates for their rigs continuing to climb going forward. So it's that's a market that maybe some investors will give credit to rising day rates because of a strong, strong growth profile going forward. Then we go around the room. Central and South America, as you can see, up about 9%. YPF down there in Argentina has got big plans to further develop the Vaca Muerta shale, and has got longer term, like pretty aggressive 5-year plans to work on that, if the country itself can solve some of the payments problems that it's currently negotiating with the IMF. Europe, like I said, is up pretty sharply this year thanks to the inclusion or the rejuvenation of the Ukrainian oil patch. But if you look at the North Sea, which is, I know, what really the focus is for most of the folks listening, we got real problems, because in Norway, a number of rigs, again, because of a strong rig demand in places around the world, rigs are leaving the Norwegian waters and going to work elsewhere. There's only about 13 available rigs that have the necessary certifications that Norwegian authorities require to go to work in their waters. Last year, there were 20 some odd of those rigs available. So again, it would be tough to materially grow rig activity in Norway if you can't get a rig to mobilize to your to that part of the basin. The UK has got issues with regard to the windfall profits tax. So it had a 40% tax. Last year it got raised, another 25% was added 6 months ago. More recently, that 25% figure was bumped up to 35%. So there's a pretty substantial tax penalty that many UK operators are facing for their operations. And that's really causing a lot of angst with regard to future field development. And so again, another reason why the North Sea market doesn't look very dynamic at this point. Africa's a somewhat different story. A lot of work going on in a bunch of different places, up 14% in aggregate. We began to see a couple of stalled projects like Total Energies one-off work off Mozambique began to be sort of brought back to life. And so Africa is going to be an interesting area. Namibia is one where both Shell and others have made some huge discoveries. And so it may be the next Guyana, although the development phase is probably 3 years away at the earliest. So, so work to go on there. The Middle East market is, as I said before, our biggest individual market and growing strongly, up about 17% this year. Aramco in Saudi Arabia and ADNOC in Abu Dhabi have plans to materially increase export capacity, the production capacity. Saudi is interesting because they want to increase their export capacity by about 3 million barrels a day. 2/3 of that basically comes from substituting gas for oil. Use more gas instead of oil to fire up their power plants, and as they produce more gas, they can recover NGLs and condensates and export that as part of their export program. So I think OPEC as a group currently exports on the order of 6 to almost 7 million barrels a day of natural gas liquids. Those natural gas liquids don't count toward the figures for crude oil production or crude oil export. But it is a substantial part of the story with regard to their production profiles there. And so Saudi is clearly poised to be able to improve its capacity with regard to the NGL story. And finally, Asia Pacific is one where we see activity up also about 10%. It's interesting because Malaysia, Indonesia, and now Thailand have all improved their petroleum industry framework agreements, which is attracting increased spending by operators there. And finally, we'll wrap up by talking about 3 areas that are pretty opaque and for one reason or another may be almost off limits for folks to deal with. But China, about 24,000 wells this year. We think it's going to be up 1, maybe 2% in terms of overall activity. CNOOC has got a big development program offshore China. Onshore, it's interesting that they're now trying to bump up their shale oil production numbers substantially going forward. So that'll be a focus of activity and maybe an area where they need some help from Western technology firms. Russia, again, we don't know what their production numbers are. They need to drill about 9,000 wells a year in Russia in order to sustain their current production, as best I can tell. And I think that's probably what they'll be able to hit. The oil sector is being squeezed for all the money it can deliver in order to try and balance the budget or fill some of the holes in the budget that they have there. But again, real strictures around what work any Western firm can do in Russia these days. So we just need to sort of monitor what's happening there. And finally, Central Asia, so the stands, right? Kazakhstan, Turkmenistan, Uzbekistan, Azerbaijan, in those areas. Roughly speaking, 700 wells as best we can tell. And it's interesting that Western governments have approached these countries to try and draw them closer together and maybe away from Russia. But not much has happened on the oil side, and in part that's because Western international oil companies look at the upstream sector in those markets and they say, man, those are high dollar projects. They're long-lived projects, so we have to invest for a lot of years before we begin to get a return. And oh, by the way, the fields tend to have high carbon emissions, and we're all trying to get out of and avoid high carbon emission production. So that has really limited the interest on the part of Western oil companies to putting more money to work in Central Asia. And so what you're really left with are Chinese firms coming in and getting the work done. And with that, I have finished my remarks and will turn it over to any questions that have been submitted from the audience or have come in to Richard, and we'll see what the group has, and we'll try and take all of them here before we sign off.
I've gotten texts, I've gotten chat box, I've gotten emails, and so we're just like, I always like giving our friend Amy the first shot.
Yes.
And her question is, if I can find it, is the following, which is how much of investment, and I'm going to interpret this as CapEx spend on, particularly domestically.
Yes.
How much of that is related to activity levels versus the inflation, or how much more expensive stuff is?
Yeah. So we'll spend this year around $100 billion drilling complete wells. Now, I would say that, so we expect to see pricing soften over the course of the year, which would not be surprising given activity forecasts we just talked about, right? So we sort of have to think about how fast did prices rise last year, how fast might prices fall this year. And when I kind of put those two numbers together, I think the average price in 2022 probably 5 or 6% higher than the average price will be this year. Prices go fast. We're coming down, but not quite as. So I'm sorry. I got it the other way around. So the average price in 2023 will be about 5% higher than the average price in 2023 than it was last year.
Even though the activity is sagging this year, we're dropping off the crap quarter from the first quarter of a year ago, and we're picking up a pretty good quarter from the first quarter this year.
So I would say about 5%, $5 billion of that $100 billion represents just the relatively higher costs. Again, it's a funny kind of a pattern because oil prices growing all of last year, they're coming down. They grew faster than they are coming down. The year-to-year averages are not exactly going to be the same. That would be my exactly on.
Another question was, have we seen with drilling activity in the gas-focused basins declining, have we seen any rig movement yet from those gas basins to oil basins? And let me take this question. And the answer is not really. And it's because it costs, let's pick a number, $1 million to move the entire drilling rig from, North Louisiana to West Texas. And we're only 2 or 3 or 4 months into this decline in rig activity. The drilling contractor would far rather keep the rig there than incur the cost of moving.
Oh, yeah.
And so there's a resistance to move.
It's expensive to move. We track well costs quarter to quarter, and one of our cost components is rig mobilization. And just mobilizing to a well in an area, not moving from region to region, just mobilizing to a well is a $200,000 item. So you can imagine the cost of going
$1 million.
Yeah.
So I'm going to spend $1 million to move it to get a $500,000 contract. So
I don't move it just for a job. I want to move it and leave it there. So.
Right. So the movement, not yet.
Right.
But if you've got 100 rig decline across the nation, and the active area is still the Permian Basin, then rigs show up. Frac spreads are easier to move because you just jump in a truck and off you go.
Yeah.
But it's on its way. What is the driver of the shift from paying down debt to buying shares back?
Oh, what drive? Yes. So I think that firms as a whole, I don't have a hard number here, but it's not like operators as a rule are debt free. They still have debt on their books, but I think many of them are approaching their target numbers. So let's say their target leverage was 25%, maybe 30%, whereas it had been over 50% for the industry as a whole, right? So So I think they're getting close to their target number, and as they get closer to their target number, then I think they're deciding, okay, take those billions that we were paying down debt, and now we're adding those billions or the stock buyback piece.
Because now the shares that used to be out there in the public, the corporation now has them.
Yes, right.
Essentially reducing the number of shares
Oh
that
yeah,
are out
no,
there.
it's
so you get a bigger piece of the
function
dividend.
of improving earnings per share. Yes, yeah.
Any idea about the amount of free cash flow that's going into buybacks?
Well, yeah. So the number from the chart was, is.
And it would only be you looking at it because it's not on the TV
I understand,
screen.
but this way I know what it is, right? So, but it has, it's grown. So, for example, in the current quarter, in Q1, that number came in right around $5 billion. It had been twice that number back in the fourth quarter of the year, but again, cash flow from operations fell pretty sharply.
Yeah.
And so, that reset everything. But I'm thinking that going forward, we'll probably see among this group of companies, all publicly traded, something around the order of $5 or $6 billion per quarter directed towards stock buyback.
To buy shares back because the debt
Right.
is about where folks want it to
close
be.
to be. Yeah,
so
right.
why pay down more debt?
Right.
There's a better use of my cash.
Absolutely. Right.
Unless the debt gets really, really expensive, and then maybe there's a reason to make that go away.
Yes, right.
But it's all about what's the best use of the next free dollar.
Right. Yep.
So here's a fascinating question. Do you think shale production outside the U.S. will eventually become a large supply of new oil? And so just as an example, Argentina is always right on the cusp in their Vaca Muerta area.
And a lot of that's gas, by the way. So
so don't count
it's not
that.
always oil, yeah.
But but shale, look.
No.
The only place that shale is with oil is not in the United States. It's not. We don't have the exclusive claim on shale that has oil in it.
Yeah.
So does it
it
become material?
The reason it became material here is because we ran out of better rock, right? We just ran out of
that's
better
right.
rock.
It was the next best thing.
That was the next best thing, right? If you look around the world, nowhere else has been drilled nearly as intensively, U.S. and Canada, and so there's a lot more good rock left and lower cost to produce from. So I really don't think that shale oil will be much of a factor, or shale gas for that matter.
You won't go there first.
Right.
You'll go there last.
Unconventional. So unconventional is a kind of a tricky thing because now you've got sandstones, right? And you can say, well, yeah, sandstone. So you might get tight gas. I mean, you look at the Saudis; they have an enormous tight gas reservoir, and that they want to develop over the next decade. And so you can get some things like that going. And what we think of as sort of the classic shale oil field.
When I think about shale and the cost of getting a molecule out of the ground, the completion part is what 2/3 of the wells cost.
Oh yeah,
now.
right here.
And heck, I got frac crews everywhere. I got frac crews running out of my ears. Because the ideal well is one where you drill the hole, you set casing, you perforate, and out comes the hydrocarbon with no water. It just comes out.
Yeah.
So the more you have to do to it, big frac job, added cost. I don't want to do that until it's the last thing that I've got to do.
Well, and the guys who have the dollars are, the Exxons and the Totals and the Shells. And what are they doing right now in terms of exploration? Offshore deep water, Guyana, Suriname, those kind of places where they're finding, right? And it just won't rise to a material level.
Okay, here's maybe the last one, unless Charlie over there tells me I need to do something else. But because I was not paying attention when you went over it, sorry.
What did you say?
I love you, and I hang on every word that you say.
But right now.
But one person wrote in to say you made a reference to increased interest in Indonesia, Malaysia, Thailand. What do you think is the incentive that makes the international oil companies say, I want to go there?
Yeah, the governments in those guys. So again, what we have to remember internationally is that almost everywhere, the government takes 60 to 70% revenue that an operator realizes, right? And so government tax regimes have a huge impact on providing incentives to oil companies to come invest there. One of the reasons Colombia in years past has been so active is because they adopted a very oil company friendly tax regime, much lower taxes. The reserves weren't great, but they more than offset that by a tax rate. And that's what's going on in these Southeast Asian countries. Governments have come back and they have lowered taxes. They've improved the cost recovery formulations and so forth. And that's what's, and so now operations just have a higher rate. That's why oil companies.
For years, one of our partners here in the firm was Kurt Minnick, and Kurt came from the ARCO International side of the business, and he was the one that helped us understand that from an oil company's point of view, the actual price of oil, a barrel of oil, has less to do with the attractiveness of a project than the amount of money that the host government will take from that project. Yeah. And so if you've got Indonesia or Malaysia, Thailand going, I'm going to let you keep more of this, right, then that's a great place to put money. Or get rid of oil price risk.
In some places, the host oil company, the national oil company, has the right to back into 50% of the project or something down the road, right? And so again, those are one of the items that you adjust, that a government can adjust and make it more alluring to outside investors to come, work in their borders. So again, we have to understand that all these countries really, when they're doing that, are in competition with other countries around the world, right? Who's got the most attractive fiscal regime? And so that's the game that
you can't just take 90% of the revenue that comes out of the well.
Not all the time. Yeah, so.
It's not attractive. So I think that's about it for now. We have we had about 70 people watch this live. We'll have 300 total over the next week or so that will watch this, and we very, very, very much appreciate the industry support of what we do. I made a LinkedIn post last night and noted that we are finishing our 58th year of doing this, because you started the company when you were 10, and I was 9, and so we're 58 years into doing this. But we've had some clients like Baker Hughes, who's been a client for 58 years, and not Schlumberger, but the Dalwell part of Schlumberger, client for 58 years. So.
Always happy.
We're super. We will keep doing this as long as you guys keep doing that. And if you're interested in the services that our firm provides, you can migrate over, link over, whatever you do, over to spearsresearch.com. Right. Lots of E's and A's, but they're always in the same order. And you can see the various services that our clients subscribe to. But I think that's it, John.
Yeah, we'll be back in September with another update. So thanks very much.
Thanks, friends. Thank you.